Hello, and welcome to Virtual Investor Conferences. On behalf of OTC Markets, we are very pleased you've joined us for the third day of our Precious Metals and Critical Minerals Conference. The next presentation of the day is from Radisson Mining. Please note you may submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for one-on-one meetings by clicking Book a Meeting. At this point, I am very pleased to welcome Matt Manson, Chief Executive Officer of Radisson Mining, which trades on the OTCQX Best Market under the symbol RMRDF and on TSXV under the symbol RDS. Welcome, Matt.
Thanks, Lily. Happy to be here. So thanks everyone for joining us. I'm going to take you through over the next 20 to 25 minutes and then time for questions. Radisson Mining, which is the O'Brien Gold Project in the Abitibi region of Quebec, one of Canada's most prolific and famous gold mining districts. O'Brien was an operating mine. I'm just going to take you through the forward-looking statements here. Please peruse at your pleasure. 2 pages. We've got to the stage where we have 2 pages of forward-looking statements. The O'Brien Gold Project was an operating mine up until the late 50s. Mine produced about 500,000 ounces at half an ounce average grade. Famous in Quebec mining history for producing rock samples like that you're seeing, which are in various famous museum collections around the world. The current resource is about 1.5 million ounces in all categories. And it grades between 4.5 and 8.5 grams per ton. These are the facts and figures of our business you're looking at, and very much whether it's the resource at the top there or also a recent economic study, a preliminary economic assessment that we completed in 2025. You're seeing snapshots of a growing business. The exploration is the larger part of this presentation, and that's been very successful recently and continues to be. So we're in the middle of a 140,000 meter drill program with 8 rigs, which is adding new gold mineralization to this inventory. And that PEA that we put out last year was us putting the flag out the flagpole as to what we think our project is worth right now with the existing resources, but before all the exploration you're about to see. That's a healthy $500 million of NPV just based on a 750,000 ounce production profile on the basis that it's going to be transported to a local mill with very healthy rate of return and low capex. So, but very much what you're seeing here is a growth story. So I'm going to take you through this. This is the who's involved. That's an important consideration for any investment in a resource company. Michael Gentili, that many people will know as a prolific resource investor in Canada. He's on our board, 5% shareholder. Pierre Baudouin, he's the person that built Canada's biggest gold mine, Detour, most recently Silvercrest, on our board. Peter MacPhail, recently retired Chief Operating Officer of Alamos Gold. Between Peter, myself, and Pierre, there's 9 mines that have been built by people on this board. That is a considerable resume that any junior mine explorer and developer brings to the table. So very much we have the capacity to push this project through. And let me actually show you where it is. This is the Abitibi, the southern Abitibi in Quebec. You've got Rouyn-Noranda on the left-hand side of that map. Ontario is just off to the edge of the page. You've got Val-d'Or on the eastern side. And these are just the operating mines and mills in the region. You've got the Douai and Westwood complex, that's IM Gold. You've got the LaRonde complex, that's Agnico Eagle. Also Agnico at Canadian Malartic, that's the second biggest gold mine in Canada. You've got El Dorado at Sigma-Lamaque. You've got West Dome at Kena. And the red hatched areas are what hub and spokes, where you've got a mill that might have been there for several decades, and successive ore bodies have been brought to production and put through that mill. This is the heritage of mining in the Abitibi, and our project just outside the town of Cadillac, we expect will probably end up being developed in that pattern, following that heritage. The closology of our project is specifically this. There's the land position. Here, if you can see my cursor, is the town of Cadillac. There's the highway and the railway and the power line all going through here. So we're right on infrastructure here. This is the kind of part of the world where you see head frames on the horizon. In fact, that inset photograph shows you the former workings of the old mine, the old mining site, the old tailings facility, and then these large mines on the horizon, specifically the LaRonde complex or the Nico Eagle, just 3 kilometers away over the back fence. And then the Westwood Doyen complex of IAMGOLD, which is 21 kilometers down the highway. Now, the preliminary economic assessment that we put out last year was about us saying, well, on the existing resources, what is the mine plan that's created out of that? And let's, under the auspices of an MOU that we entered into in 24 with IAMGOLD, to do a milling assessment based upon our ore going to that particular mill, what does this project do? When we don't have to build the mill and we don't have to build the tailings facility, we keep the capex low and the ore is going to somebody else's mill. And that was a very successful PEA, again, $500 million of value, 44% rate of return. We used 25.50 gold for that economic assessment. So not overly ambitious in terms of the economic criteria that went into this. And it stands out very well. The mine plan that we conceive of currently is ramp access from the surface. This is, again, the mine plan based on the existing resources just up until 2023, based on drilling to the end of 22. And that produces about 70,000 ounces a year for 11 years, a very high margin project. Again, we designed the mine at $2,000 gold, did the economic assessment, 25.50, and gold's currently at $5,000 gold. So like many in the gold mining business, really high value margins in these types of projects at this stage. The old mine there you see on the left has existing infrastructure, including a shaft that goes to 1 kilometer depth. So that's not incorporated at this stage into our mine design and our thinking around mine design, but it's an opportunity for the future. And so our perspective in this project is about going down. So let me take you through the exploration story here. And sorry, before I do that, summarizing the numbers on that PE again, there's $500 million of NPV at 25.50. That's $1.2 billion Canadian using just $4,000 gold. An 11-year mine life, the capex of $173 million. That means the NPV to capex ratio, which is an important metric in our business, is 3, which is very high. So that tells you something about margin, capital intensity, and affordability to do this type of mine development. Okay, so let's get to the exploration story here. This is the geological map of the southern Abitibi, and those are all the current and former mines in this just in the immediate environment of our project. And on the bottom, you're seeing these gold deposits in long section. Now, they're all slightly different in terms of geological setting. The LaRonde deposit there, currently down to 3.5 kilometers depth, is a large, massive sulfide polymetallic deposit. The others are usually, though, gold only, vein type deposits, and most of them are touching 2 kilometers in depth. There's Westwood on the left-hand side of the image, and there's Lapa, which was on a Nico Eagle mine up until 2018, did about 100,000 ounces a year for about 10 years, developed underground with a shaft and trucked to the LaRonde mill. Lapa is the analog for us. Same metallurgy, same geology, high-grade quartz sulfide veins in the Pichet Formation rocks. That's that band of yellow rocks on the upper map. And so what we've got here is not unusual. It's a very typical high-grade quartz sulfide vein deposit in the Pichet Formation adjacent to that Larder Lake Cadillac fault break, which is a major crustal structure in the region. So there we are in the middle, 5 kilometers of strike in this very prolific part of the world. Zooming in on that, there's the old mine. There's the current resources, again, from 23, based on drilling to the end of 22, 1.5 million ounces. The exploration thesis for us is knowing how deep our neighboring deposits go, knowing that there is shaft access here on our property to 1 kilometer depth, on neighboring properties deeper. What does this deposit look like going down? In 70 years since that mine closed, nobody had thought to drill below the final mining stope. Now, I'm going to show you what happened when we did that. The target here is if the old mine continues to that 2 kilometer floor, and if those new resources on the eastern side of the old mine also track to 2 kilometers floor, so this mesothermal gold deposit continues down, which they usually do, what we get is 3 to 4 million ounces in that grade range. That's the target. So for the last year, we've been doing this. We haven't been nibbling around the edge of the former resource. We've been doing these big step outs, going hundreds of meters out, drilling intentionally into the white space on the graphic. The drill hole that went below the old mine for the first time in 70 years went 500 meters below the old mine and went through an ounce of gold over 8 meters. Since then, that's hole 337. Since then, we've drilled 15 wedges off that hole. That's that cluster of hits, the balls, the purple balls, the yellow balls below the old mine. They've all hit. And in fact, they've all gone through multiple vein structures. But we've been hitting on the western part of the old mine. We've been hitting below the modern resources on what we call trend 1, trend 2. We're hitting at this stage everywhere. And this isn't rocket science. This is what this type of vein deposit usually does. It usually has depth extent. So far, so good. We started this deep step out program about a year ago. This is about a year's worth of deep holes. We're hitting everywhere. This graphic appears on every press release we issue with drill results, and it grows with every press release. So you can actually see the progress as we fill in that white space. And this is something else we put onto our press releases. This is the score sheet. There's the date of a news release with drill results, the number of holes reported, and we put out every hole. We don't hold any back. And then the modern cutoff here for mining will be about 2 grams. So if we get an intercept that's 3 grams or more on core length, we know that's going to true up to a resource block, because our ore body here will be about 3 meters wide. There'll be a vein in the middle, which is 0.5 meter or 1 meter wide, which is carrying most of the gold. But then you'll have an alteration envelope, which comes out to be about 3 meters, which is also mineralized. And the bottom cutoff for that will be 2 grams. So if we're going through that type of zone, with a drill hole and getting 3 grams or better, we call that a hit. That's likely going to contribute to a future mineral resource. So this is the score sheet on getting hits. 84% success rate so far after a year of doing this. I mean, that's terrific. Some of you who are in the mining business might know that if you're drilling to convert an inferred mineral resource to a higher confidence indicated mineral resource, you might budget for 50 or 75% type success rate in terms of hits and non-hits. We're getting 84% here, drilling into the white parts of the section with step outs of hundreds of meters. So that's telling you something about the ubiquity of this gold mineralizing system going down. In cross section, here's those drill holes and wedges below the old mine in cross section. The stripes of rock going down in that cross section are this P-shaped formation, metasedimentary metavolcanic rocks, big slugs of metasedimentary rocks on the left, the hanging wall, that's called the Pontiac group, big slug of metasedimentary rocks on the right footwall, that's called the Cadillac group. And in gray, there's the stopes, the mined out stopes of the old mine coming down. And that is about a 600 meter now vertical interval of hits as we go through multiple veins. Now, this morning we put out a geological press release. It was lengthy, it was about 11 pages long, and it had lots of graphics in it. But that press release was showing this, because it's one thing to hit gold in a vein deposit, but are you getting continuity? The most important criteria for being able to mine this becomes continuity of mineralization, continuity of grade. So we've been modeling these hits into this vein model that you see here. On the right, you've got the full, now 1,700 meters of depth extent. There's the old mine coming down to 1 kilometer. Here is the new drilling coming in with the wedges, and we're delineating up to 8 veins below the old mine. Now, why 8 veins? The old mine was a single vein, and they high-graded it. Back in the 30s, 40s, 50s, they took the eyes out of the deposit. They probably had a cutoff of like 7 or 8 grams. So they were mining everything above 7 or 8 grams per ton, leaving everything else in there. And they were achieving about 0.5 ounce average grade, 15 grams per ton average grade in the mining. Now, today we would go down to, as I said, 2 grams, and we would take out more than that. And we know from the old mine that as they were mining down that central stope and central vein, they were discovering to the left and to the right parallel structures that were 5, 6, 7, 8 grams per ton. That wasn't ore for them back in the 50s at $35 an ounce gold. That's ore for us today. And so that's why I say they high graded the old mine. They left a lot behind. So as we now drill through this geological system below the old mine, we're hitting all these parallel structures. Up to 8 now we delineated. And on the left, that kind of reddish brown vein there that we're focusing in on the left of that slide, that's the main vein. That's the high grade main vein continuing down. We've got it on every pierce point as we go through it. The purple circles are above 9 grams per ton. You see some of the grades are double-digit grades as we go through this thing. And then the deepest hole you see there, 378, it hit it as well. Lower grade intercept, but that's okay. We're getting the continuity. We're seeing the mineralization coming down. That's now 700 meters of that vein, top to bottom. But we're seeing all these parallel structures as well. So this is going really well. We're dialed in here. We're getting continuity. It's repeatable. And we're using this model for 2 reasons. It's guiding future exploration, right? We see where this thing is going. We establish a target. We chase that target and we hit. And we're also, it's going to be the constraining geological model for a future mineral resource update. And we said in the press release this morning, the last time we did an estimate of a resource, 23. And so we're now going to do a new estimate quite shortly before the end of this quarter. There's going to be a lot of drilling here required to get up to that 3 to 4 million ounce target that we think is here. But we think we can show on an iterative step-by-step basis growth in these resource numbers from this drilling as it progresses. So you're going to see the first of those steps relatively shortly. And I think we want to communicate the steady growth that this type of successful drilling is giving us. To the west of that section I showed you and to the east of that section, it's the same pattern. There is the drilling below the old mine on the western side. There's the drilling below what we call these trends 1, trends 2 of the new resource on the eastern side. Same continuity, hitting when we go into the Piche formation, multiple veins. This is a very predictable mineralizing system. It behaves itself, and we're getting good predictability in our results. So just to sort of wrap this thing up, so next steps. Well, the exploration is going really well, right? I came in as a CEO a year and a half ago. Michael Gentili became an investor about 3 years ago. Pierre Baudouin came onto the board 3 years ago and became chairperson when I came on as CEO a year and a half ago. Our principal mindset is this is a mine. Where does it go? Which existing operation is it likely to go towards? But the exploration, the step out drilling, to be honest, has been better than we expected. And this project is getting big. So it does actually work as a standalone project, not requiring anybody else's infrastructure. This raises some very interesting opportunities for us. And so the exploration very much is about 90% of our business right now. We're fully funded for a 140,000 meter drill program, up to 8 rigs. We did 35,000 meters last year. We're doing about 75,000 this year. There'll be another 30,000 or so at the beginning of 27. The target is to go down to 2 kilometers. We think that's the current exploration horizon. May not be the final exploration horizon, but it's the current one. And again, I think it behooves us to give guidance through this process. We're not going to wait until the middle of 27 to tell you what we got with all this drilling. We're going to show an iteration, step-by-step guidance on what this is doing to our resource. On the development path, we know there's a mine here. That PEA that we did last year shows a credible, economic, high-margin, viable project. And so we're pushing down that path as well. And that means the nuts and bolts of mine development, which I'm very familiar with. I've done it 3 times already. So this is environmental baseline work. It's community consultation. It is additional iterative engineering studies. And in our case, it's also conversations with potential processing partners, because it's a bit of a nonsense to imagine that in this part of the world with so many mills and so many tailings facilities and existing operations that you go out and do it yourself again. I think we have that opportunity to do it, but the best situation is always going to be using existing infrastructure. And before I finish this off, just a quick note on gold prices. We're at $5,000 gold, up and down. I know it's a volatile day today. You know, we can't be too seduced into planning our businesses in those types of prices. And we haven't been at Radisson. We've been using $2,000 gold for a resource estimate and for mine design. I think probably 2,500 is a reasonable step up from that for the future work. But if you want to use higher gold prices, you know, at $4,000 gold, you know, every gold project has more ounces, more tons at a lower average grade. That's always going to be there. When you're planning a mine at $2,000 gold, if you use a higher gold price, you're going to get more tons, larger stopes, and better continuity. All of that upside is here. This is why investing in gold equities really is recommended. Economics of a project, it's all the way through it. For us at Radisson, our discovery cost is $24 US an ounce. This is not an expensive place to operate, right on the highway. Our drillers go home at the end of the shifts. And in terms of a company valuation, we're being valued right now at about $150 US an ounce, with a low capex project at $5,000 gold spot. So, you know, that's the investment opportunity. In terms of the market cap of the company, it's about 324 Canadian. Share price at close yesterday was 76 cents. 400 million shares outstanding, quite tight in terms of options and warrants. We raised $25 million back in October with a broker deal, hard dollars only, no Canadian flow-through dollars in there. So fundamental long-only precious metals funds buying that issue. It was very institutionally heavy. We raised $25 million. The book was a lot larger. We've always been quite disciplined here, I think. $32 million in the bank at the end of the year. So we're fully funded for all of this exploration I've been showing you today. And a healthy share register, becoming more institutional, very important block of 27% regional high net worth individuals around the project who know mining in the Abitibi, who see the value here and who have invested. And about $1.75, $1.85 with the two analysts on the street with prices, Beacon and Cormark, and Argentis, of course, covering us as well in Vancouver. And that is my presentation at 22 minutes. It leaves time for Q&A. This is the contact information. If you want more information, you can contact me directly at the information shown there. Hubert Parent-Bouchard, our CFO in Rouen, or Christina Pilon, Investor Relations in Vancouver. And thank you very much. So I've got a bunch of questions here. So I'm going to try and go through them in order. And apologies if I don't get to your question, because there's quite a few here. Why do you think it isn't important to have a low-cost startup like many other companies are doing? Will you have enough cash without this? I have built mines in the past, and I will tell you that the way to do it successfully is to have a strong mineral resource, strong social acceptability. Those are the two pillars. And then to fully commit to the proper mine. Size it correctly, cost it correctly. Don't try and bootstrap your way up. Don't try and start small and bootstrap up, because the first problem you have puts you into reverse. So I've had success in my career not trying to cut the corners in scope and scale of a project. And certainly I'd bring, and I think the rest of the board feels the same way, and we'll bring that ethos to this project as well. But again, I think the logical outcome for this project is the use of existing infrastructure, which lowers the capex, lowers the footprint, and gives a cost of entry into a mining situation here, which is really quite low. With $32 million in cash, no debt, and a fully funded 140,000 meter drill program through 26 to 27, how much optionality do you have to time future equity or strategic financing to maximize value rather than just fund survival? Well, yeah, I think we've got a lot of opportunity. We're fully funded here for all of the technical work we're doing. We're also fully funded for corporate costs. You see me working from home here. We're not, our head office is actually at the mine site in Quebec, in Rouen, just more Cadillac. So I think we've got lots of optionality. Since I joined the company 18 months ago, we've done 3 financings at progressively higher prices. They've all been well received. The stock has traded well after each financing. So I think again, we've demonstrated that we can raise capital and spend capital well in an efficient manner in this company. Next question. So you have assembled a board and management team with Chief Operating Officer, CEO experience from Detour, Silvercrest, Alamos, Renard, Valentine, and others. How are you yep, those are the 9 mines. There's other names as well there. How are you leveraging that track record to fast track O'Brien toward construction readiness and position Radisson as a future mid-tier, not just a single asset explorer? Well, yeah, I think we know what we're doing. We're all here because we see the mine. We're not here to drill this deposit as explorers for the next 10 years. So I don't think any of us would be interested in just, you know, the exploration here. There has to be a mine. So that's the first thing I'd say about that. And yeah, look, I think when it comes to, again, I gave a little bit of the ethos on how to do it properly. Fully commit to the proper development path for the asset. Don't cut corners. Don't try and start small and bootstrap up. You know, what is the right size of mine? How should it properly be built? What does that cost? And then commit to that. Again, the board gives us the capacity to take this company all the way through into construction and production. But it also means that, you know, there isn't an itch to scratch on this board to do that necessarily if another path opens up, which is a better outcome for shareholders. The hardest thing to do in the mining business is to take a single asset from exploration through permitting into construction and into production as a single asset company. That is a very tough journey. So I think this board, how you should think about this board is optionality. It gives us the ability to do that or not to do that. And I think there's a lot of gray hair and experience that serves Radisson well. As you progress community consultations and environmental baseline work, is there anything in stakeholder feedback so far that reinforces the long-term mining camp potential of O'Brien rather than just a single mine project? I'm not quite sure I understand the question. I mean, O'Brien is a single project right now in a company. You know, we're not a multi-asset company, but we're surrounded by other projects. And so the gold metallurgy of this part of the world is exceptionally rich. So it is a mining camp. That's an expression which is overused, I think, by explorers who want to give an impression that they've got multiple ore bodies in our camp. This is a camp. I mean, this has been a camp for 100 years. So I think that's well understood by communities. And if you live around these mines, you feel the vibrations of the blasts as the mining progresses, right? So there's a tangible connection. A lot of people work in the mining industry. There's full employment in the Abitibi, in the mining industry. Finding people is hard. It's one of the challenges of the mining industry in the Abitibi. So I think we are presenting our project in the correct way to the stakeholders, and there's an understanding of what our business is with stakeholders. Given your location between major hubs like LaRonde, Canadian Malartic, Goldex, Westwood Doyen, how much interest are you seeing in potential toll milling or broader strategic partnerships beyond conceptual Doyen now in the PEA? In the gold business, and especially in the gold business in prolific camps like Quebec and Ontario, the Abitibi, there is conversation between companies all the time. And we think our dance card for potential processing partners is pretty long, and it is active. And I think that's the normal course in our business in this part of the world. look, I think toll milling agreements are actually relatively rare in the gold mining business, because the owners of mills generally don't want to have somebody else's ore in their mill. They want to have their own ore in the mill. And so when companies, so we did a PEA based upon a toll milling scenario, because we don't want to build our mill and our tailings facility there on the site, because it'd be a nonsense, because there's so many others with capacity. So when we do something like that, we're, as well as telling you what this is worth in a toll milling scenario, in one of the several options that are available, we're also communicating just what this project can do if you own a mill. So that kind of study works on different levels, and whether or not that ends up being a toll milling deal or ends up being something else, or as I said, ends up and us committing to our own milling facilities, it's still something that is to be determined. I think there are several paths open to this company. Having established that there are several paths open to this company, our focus becomes the drilling, the exploration. This thing's getting bigger. And frankly, that's the investment thesis. Hot drill results, and it's getting bigger. That is the fundamental investment thesis. And let's see how that translates into the future. You have strong analyst coverage with $1.75, $1.85 targets versus 76 cent current price. What do analysts see that the broader market doesn't? Well, that is a fundamental question about how you invest in junior mining companies, how junior mining companies are valued, and how the analyst community works in terms of valuing companies. So there is, the analysts are establishing a good faith target based upon their long-term gold price assumptions and what they think the project currently represents. Their targets will move upwards as the gold price changes and as the project gets more valuable. And there is always a discount between their targets and where the company trades. The fundamental question behind your question is, how do you value junior mining companies in this gold market? And current valuations, to be perfectly frank, are a complete nonsense compared to the value of the deposits when mined in this gold market. And so the question should be, when do junior mining companies get properly valued? $150 US an ounce that we're valued at, that is a higher valuation that we might have had 12 months ago. It's a nonsense compared to what it costs per ounce to build and operate the mine, and a $5,000 spot price. So I'd invite you to apply that logic to every gold mining stock out there, and you'll see that the whole sector is undervalued. And I think probably one last one, I'm running out of time here, I think, but with 84% drilling success rate over the last 12 months, what percentage of your 140,000 meter drill program is focused on resource expansion versus infill drilling? All of it is resource expansion. All of it is resource expansion. We're not interested in infilling. We're not trying to drill off individual mining stopes for a feasibility study here. We want to know how big this project is, and it's getting bigger. So we're doing big step outs. We're not worrying about the quality of a resource. We're just worrying about the quantity of a resource. We think we can demonstrate good continuity relationships with our modeling and with the old mine and with the data we have. And with that confidence, we're stepping out. We want to know how big the thing's going to be. So 100% of the drilling is scope, not infill. And I think that's probably got to be me. I think I'm up to half an hour. Unless Lily comes back on and tells me I can keep going, I think I've got to hang up here. Thanks very much for joining this. Thank you for all your questions, and have a great day.